So the earnings from Singapore's big three banks are in, and yet again, DBS has done the best. But did you know that DBS shares have vastly outperformed those of OCBC and UOB over various timeframes? For example, over the past 12 months, DBS shares have given a total return, so that's share price appreciation plus dividends, of 60%. That's over double that of UOB and OCBC. And over the past 10 years, DBS shares have delivered investors a total return of 340%. Again, over double that of UOB and OCBC. So I'm going to give you three big reasons why I think DBS shares have left OCBC and UOB shares in the dust. Number one, DBS's scale and simplicity. Now, DBS is the largest bank in Singapore, but its shareholding structure is pretty simple. Temasek is the largest shareholder, but it doesn't really get involved in the day-to-day operations of the bank. If you look at UOB, it owns a variety of businesses through the We Investment family. It owns stake in, for example, UOL, which is a listed property developer, as well as Hor Pa, which is also a listed company on the SGX that owns the Tiger Balm brand. If I was a UOB shareholder, I wouldn't want the We family to be concentrating so much on brands that are not the main UOB banking business. As for OCBC, well, it owns a stake in Great Eastern, and that's a legacy stake in an old insurer, and its delisting resolution recently got rejected. And now a lot of investors don't really view UOB or OCBC as maybe pure play banking stocks. Number two, DBS's leadership plus acquisition strategy. Now, this is really important because for about 15 years, Piyush Gupta was CEO of DBS, and he drove digital change and transformation at the bank. It also had a very smart acquisition strategy. Remember, in 2017, it acquired 5 of ANZ's private wealth businesses. And what drove the majority of earnings growth in DBS's latest quarter? Wealth management. Now, UOB and OCBC have lagged on the digital front, and OCBC has really not been that active at all in acquiring new businesses to drive earnings growth. Finally, number three, dividend growth. We all like to get dividends from Singapore banks, and DBS is the best at giving back higher dividends to shareholders. From 2009 to 2019, the bank grew its ordinary dividend per share at an annualized 8.2%. Now, this compares to 6.3% for UOB and 6.6% for OCBC over the same period. So there you have it, 3 big reasons why I think DBS shares have outperformed those of OCBC and UOB over the long term. For more personal finance and investing insights, give me a follow here or subscribe to my free weekly newsletter at timtalksmoney.com.